The rally is over and futures are down 30 minutes until the start of cash trade. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is at the Milken conference in Beverly Hills, and Bloomberg Open Interest starts right now.
Coming up, stocks stall, Wall Street's winning streak comes to an end, and attention shifts to the Fed. Plus, earnings drag. Ford and Mattel join the growing list of companies warning of the impact of Trump's tariffs, and Treasury Secretary Scott Bessent heads to Capitol Hill to defend the president's fiscal agenda.
Meanwhile, some stocks to watch on the earnings front. You have Palantir raising its revenue forecast, but Wall Street had very high expectations. More on that in a moment. But, Matt, you can see shares down 8% in the pre-market.
Yeah, almost decimated in the pre-market. Ford also taking a hit today. The automaker is the latest to withdraw guidance, saying tariffs will cost the company more than $1 billion. Here's the CEO, Jim Farley, on the call last night.
Based on what we know now, our expectations of how certain details will resolve around tariffs, we've estimated the gross impact of tariffs for full-year total company EBIT of $2.5 billion and a net impact of $1.5 billion.
Let's discuss with Bloomberg's global autos editor, Craig Trudell. So, Craig, a lot of interesting news out of Ford. Not only are they pulling their forecast, but they're going to bring some parts into the country with bonded importers, whatever that is, and they're waiting on price to see what competitors do.
Yeah, that's right, Matt. And I think we can still sort of parse what exactly that means in terms of how they're going to mitigate things here. But I think it speaks volume, this idea that $2.5 billion hit to a company that of the vehicles that it sells in the U.S., about 80 of those are made in the U.S. So even in a position where you're outproducing the rest of the industry, the number two in the U.S. In terms of local production, Jim Farley talked about last night, outproducing them by about 300,000 units. Even still in that position, because of the parts tariffs, this is going to have a substantial impact even for a company like Ford.
Yeah, it looks like Ford's set to wipe out its year-to-date gains at the opening bell. Let's talk about another car company. I want to talk specifically about Tesla because they rolled out this updated Model Y, its most popular model. But you saw in Europe that sales absolutely plummeted. Craig, what do we know there?
Yeah, I think a lot of people were inclined to sort of, take the steep declines that we saw in the first quarter for Tesla across Europe with a bit of a grain of salt, right? Where the expectation was that, a substantial portion of that was this changeover to the Model Y, where you had factories around the world that were down for several weeks because they were changing over to this redesigned vehicle. And that's going to inevitably lead to disruption. That's, commonplace for all sorts of manufacturers. But for Tesla, this is an indication that this is not just a Model Y story. This is not just a changeover issue. This is potentially a major issue in terms of Elon Musk, sort of hurting his biggest and most important company in the form of alienating a lot of would-be customers over here in Europe, where we've seen a substantial pickup in electric vehicle adoption early this year. Tesla has not been able to take advantage of that. Instead, they've been losing quite a bit of ground.
All right, Craig Trudell, with the latest on the autos, we appreciate your time. Let's go back to Palantir because this is an interesting one. The firm actually raised its 2025 revenue forecast, but Wall Street isn't impressed. You can see that in shares in the pre-market. Bloomberg Technology's Caroline Hyde is here with the details. Caroline, the company described ravenous demand for their AI
ravenous
products.
Whirlwind.
It's not translating into the shares.
I mean, Dr. Karp has fruity language. He does it best. But they do deliver in terms of their earnings. You saw profitability, adjusted EBITDA, coming in up 69%. You're seeing revenue climb 39%. They're raising their guidance for the year. But this is the most expensive stock on the NASDAQ. We're seeing the most expensive valuations of 200 times future earnings, mainly a retail-driven name, considering some analyst expectations. You're seeing Brent Thill thinking in many ways this has been a retail darling that has driven it up more than 60% year to date. We're pulling back from that in the pre-market because, yes, they raised their guidance, but people needed to see a little bit more, particularly from the international side of the business. US is growing great guns. We're seeing in particular US commercial side of the business, 71% year-on-year growth. We see resilient government spending as well, which many have been worried about considering Doge and the pullback, but no, they seem very well aligned there. But it's the international catalyst. That's what's missing, and people wondering, okay, how do they really grow into this valuation number right now?
Let's talk a little bit about, speaking of ravenous demand for AI, OpenAI, and their plan to shift to a for-profit structure. They're walking that back, and Microsoft is not on board with it, a key shareholder.
Reporting coming from Dina Bass, Shireen Ghaffari over in SF and the West Coast, really talking about how it is Microsoft that has been why we're not hearing the clarity and the detail right now. They're having to pull back from a full shift to full profit because basically the attorneys general of California and Delaware didn't like the way in which they were recompensing the charitable arm, the not-for-profit. They'd also had a big argument coming from Elon Musk, which co-founded the business back in a decade ago, walked away, now has his own rival, and many would say at OpenAI, you're doing this to slow us down, all the courts and all of the legal wranglings coming from Elon's side. But also academics didn't like, the civic leaders were worried about ultimately what this says about a company trying to transition when it's thoughtful about doing all of this for humanity, but then goes for a totally for-profit kind of an agreement. So at the moment, they're going to remain non-profit oversight, but it's shifting to a public benefit corporation. That LLC goes to a public benefit corporation. Microsoft, though, just wanted it cleaner. So did most investors in this business. Remember, they had a capped profit model. That goes, so now they can keep on growing and they can hand back more money to private investors. SoftBank is in board. That's really important because they're, of course, the ones that still have about $30 billion to give in that recent mighty fundraise that valued the company, OpenAI, at $300 billion.
Yeah, one of the most valuable private companies out there. Some fascinating palace intrigue to go along with that. Yes. That is Bloomberg's Caroline Hyde. And you can catch her on Bloomberg Technology later today when the CEO of IBM joins the show. Looking forward to that one. But it's day 2 of the Milken conference in Beverly Hills. And so far, investors are saying that they can live with tariffs and a reworking of trade, but they want progress soon.
What the administration wants to do, in my opinion, is not wrong.
He, I think, did the right thing in pausing tariffs, reciprocal tariffs for 90 days. And I think the next step probably should be, I call it a 180-day pause, take down the China tariffs.
You can sort of see the administration walking back some of the more novel ideas they've come up with.
I see us moving from what was hyper-exceptionalism to merely exceptional, because I don't think there are good alternatives to the U.S. today, but that can change over time.
To quote Queen Elizabeth, just stay calm and carry on.
The level of engagement everywhere around the world is absolutely tremendous. It's about scenarios right now. It will turn into action further down the year.
Sonali Basak is there in Beverly Hills. So, Sonali, who do we have lined up for today?
Another all-star lineup for you, Matt. We do have a lot of titans of private capital today. For example, Marc Lipschultz, the co-CEO of Blue Owl. We will be speaking to John Gray as well, the COO of Blackstone. Mark Jenkins, the head of credit at Carlyle. Later, we'll also be talking to, in the 12 o'clock hour, Todd Boehly, as well as Katie Koch, the CEO of TCW. Todd Boehly is actually a pretty interesting one today, guys, because that movie tariff that you're seeing from the administration, he's actually a backer of a major film studio, A24, behind some major films, including Civil War and Everything Everywhere All at Once. So we'll be hearing a billionaire's perspective of targeted tariffs that will directly impacting portfolio companies. Of course, I don't know if you caught it yesterday, Scott Bessent, the Treasury Secretary, spoke to the idea of private credit and just how much activity has been moving outside of the banking system under the weight of regulation into the arms of private credit. Now, we have seen a wide range of opinions here about the state of the economy and the underlying performance of these assets. Some say everything's going to be fine, but of course there are cracks forming. We've seen it. We'll be talking to people a lot about what they're seeing.
All right, Sonali, looking forward to that lineup. You can catch Sonali all day in Beverly Hills at the Milken conference, and we'll also be back with her later this hour. Meanwhile, let's get a check on futures right now because it's another day of red on the screen. You can see the S&P 500 down about 0.9%, and it's big tech that's leading it, down about 1.2% on the NASDAQ 100. Small caps also getting caught up in the sell-off as well. It's interesting to see what the next catalyst will be, Matt Miller. Maybe it's Fed Day tomorrow.
Well, and it could be Bessent as well today. it's not that long ago that any talk of trade moved this market, right? And now we've grown a little bit numb to it, I think.
Yeah.
But we'll pay very close attention to what he says on Capitol Hill. Also, close attention to what's going on in Germany. Friedrich Merz is taking another shot at securing Parliament's backing as Chancellor after a jaw-dropping miss this morning. The Germans are at peak Germanness right now. This is Bloomberg Open Interest. Let's get now to high interest. Look at what's making headlines around the world. Teflon Barbie, she is not. Mattel is withdrawing its forecast for a return to sales growth in 2025, citing President Trump's plan to impose tariffs on imported toys. Just 3 months ago, the toy maker had predicted sales of Barbie and Hot Wheels cars would grow as much as 3% this year, but Mattel plans on increasing prices on some toys and diversifying its supply chain to offset the potential impact of tariffs. The decision to withdraw guidance casts a shadow on what was otherwise an upbeat first quarter. And the European Union plans to hit over $100 billion worth of U.S. goods with additional tariffs in case ongoing trade talks fail to yield a satisfactory result for the bloc. The proposed retaliatory measure would be shared with member states as early as tomorrow, and consultations will last for a month before the list is finalized. Negotiations between the EU and the U.S. began last month, but little progress has been made, and the expectation is that the bulk of the American tariffs will remain in place. And in just a few minutes, Germany's Friedrich Merz will make another attempt to secure parliamentary backing as the country's next chancellor after his humiliating shock loss in an initial vote. Merz fell 6 votes short in a vote earlier today that had been expected to be just a formality. His failure to secure the chancellor's seat in the first round of voting was really unprecedented and an unexpected twist that now pitches Europe's biggest economy into uncharted territory. Let's bring in Bloomberg's Oliver Cook standing by in the Hauptstadt. Oliver, does it look like Merz can get it over the line in a new vote that's scheduled for just about 5 minutes' time from now?
Listen, Matt, it looked like he could get it over the line the first time around, and it didn't happen, and it absolutely shocked everybody. I mean, everybody that you spoke to about this, everything you read about it, all the preparations that everybody made, basically saw this as a rubber stamping this morning, the first step in sort of a series of steps that would lead to the end of the Olaf Scholz chancellery, handing over the power today from Olaf Scholz to Friedrich Merz, and that is not at all what happened. This was a complete shock to everybody who was observing it, to such a degree, Matt, that really people didn't even know what the next step, what the procedures would be. They literally had to take out the Constitution to consult it, to look at Article 63, to figure out what to do next, because this has not happened in modern German history. And we should just say that this was a government that was supposed to take Germany out of the political turmoil that it's been living over the last 3 or so years with that sort of three-way coalition that really didn't see eye to eye on a number of issues. This was supposed to usher in an era of stability, the Grand Coalition, the CDU, the SPD, a very comfortable political arrangement, generally speaking, within Germany, and that failed. And it just speaks to how conflicted the German political order is right now, and actually how weak this coalition is going forward, and how weak potentially also Friedrich Merz is himself a candidate. We expect the voting to start basically right now. If he fails again, Matt, that would be a major blow. There will be some serious questions about whether or not he is going to be Chancellor of Germany.
Well, let's say that he succeeds. If he does, I mean, given that we had this episode, as Matt called it, a humiliating loss, does this weaken his position?
I think it absolutely weakens his position. I mean, again, there was already questions about whether or not he was going to be the right man to lead the CDU into this election. There were some real doubts about that. He's not the most sort of charismatic leader. There's a lot of doubts about his ability to sort of get things done and really rally and unite Germany, which is also very politically fragmented. You're seeing a lot of the same rhetoric that you saw out of the United States in the lead up to the U.S. election, where you have the AfD, the far-right party here in Germany, that over the last couple of weeks has actually been polling #1 in Germany, and they're their pitch to the German population has been basically that the mainstream political system within Germany is broken and is ineffective. They cannot get things done. And, they will see this today as another example of exactly that. And I think it will also bring into question about how effective this government can be going forward in terms of deploying that debt-fueled sort of fiscal stimulus, that €1 trillion worth of fiscal stimulus that they basically okayed on infrastructure and defense spending. There's going to be some real questions about how quickly that can get out the door. The idea was to get a chancellor into the office, get him in quickly, and hit the ground running. He didn't even hit the ground today.
Oliver, what happens if Merz fails to secure the amount of votes that he needs? I mean, he has been trying to get into the chancellor's chair for at least 20 years, right? And he's always sort of come short. He lost out to Angela Merkel for decades. Maybe the country and the parliament is behind these policies, but not Merz as a chancellor. Is there anybody else who could step up?
Well, listen, this is going to be potentially an active question. I mean, we heard from some of the lawmakers in the outcome of the vote right afterwards. We should say the moment that they announced the outcome of the vote, you saw Olaf Scholz's jaw literally drop, shaking his head. You had Alice Weidel, the head of the AfD, the far right, basically started laughing, erupted in laughter within the chamber. And we heard from a number of lawmakers, other ones from the sort of far left of the political spectrum, Die Linke, the left party, saying that basically if Friedrich Merz cannot even get the Berlin bubble to heal, get them together, how on earth is he going to unite the country? And maybe he's not the right person to do it. So listen, Matt, I think that we are sort of asking a legitimate question. I do still think that the base case is that Friedrich Merz will be able to make it through as chancellor. But again, in a world of sort of non-zero chances in sort of politics across the world, really materializing against the odds, we'll have to see what happens over the next couple of minutes as the lawmakers right now in Germany, as we speak, are voting on potentially bringing in their next chancellor. Let's see if it happens.
All right, Oliver, thanks very much. We're going to continue to cover this. Obviously, this vote going to take place during this hour, and there's a good chance that we'll get the vote before the end of 9 o'clock.
And to that point, you can follow along the vote in real time by going to Live Go on your Bloomberg terminal. But coming up, we'll go back to the U.S. equity market because under 12 minutes before those bells ring, we'll start today's trading day with JPMorgan's Sitara Sundar. This is Open Interest. Investors looking for safety should avoid U.S. equities and the dollar. That's according to strategists over at JPMorgan. They say that concentration risk in U.S. equities is, quote, extreme, and there is significant overvaluation. Sitara Sundar is JPMorgan Private Bank Head of Alternative Investment Strategy. And let's start there, because I imagine you're fielding a lot of questions from clients about where are we, where should we be putting money to work? How are you viewing the U.S. right now?
Look, I think that it's first, thank you so much for having me. I love being on. Look, I think that it's fair to say that some of the shine of U.S. exceptionalism that we and the entire street were expecting coming into this year has dulled a bit. I do think that it's important to note, however, that there are still, we just are in the middle or towards the end of Q1 earnings season. Earnings have come in strong. We're tracking at about 12-13%. Obviously important to acknowledge that a lot has changed since 1Q. But tech companies have been doing okay. And the biggest thing that we've seen for us, from our perspective, is that we're seeing breadth from an earnings perspective. Healthcare is among the top of the leaderboard, financials too. So when we think about that entire mosaic of what's going on with trade policy, what's going on with fiscal policy, what's going on in terms of the policy priority shift that we've seen so far this year, we still think that there are opportunities within the U.S., but it's extremely important to be selective within that, because we're going to see volatility at the headline level like we've already seen so far this year. And the biggest thing for us is we also do agree. We've always said that global diversification is extremely important, but not all of our clients have that type of exposure. So what we've been telling folks to do is maintain your U.S. exposure. Perhaps if you've been leaning in a very meaningful overweight, taking some chips off the table and going towards more non-U.S. markets, Europe and Japan are at the top of the list.
But it seems like you're struggling with the same kind of soft data turning to hard data issue that the Fed is, in a sense, right? Earnings are hard data, but earnings were very good. I mean, 12 to 13% is incredible growth in Q1. How much of that was pulled forward, and how concerned are you about, growth contractions in 2 quarters. We heard that from Marc yesterday of Apollo.
So it's really interesting because 1Q came in better than feared, but what we've also seen is 2025 and 2026 earnings growth expectations coming down a bit. Now, not more than what we've seen in terms of historical averages, but still coming down. But our base case is still for moderate economic growth that's going to support above average earnings growth moving forward, both in 25 and 26. A recession is still not our base case. So what we're telling clients to do in this period of time right now, we have to acknowledge and have some humility as equity investors, the same way that you see companies either not putting out guidance or putting out different scenarios. We're also probability weighting scenarios when we're advising clients where to put that incremental dollar to work. And when we look at that entire mosaic, we're still constructive, but it's extremely important to be selective, and portfolio resilience is key. Within the United States, there's a big tech overweight that many of our clients have, adding to quality defensive, adding to quality dividend paying stocks that are still trading at a meaningful discount to the index level. And international diversification gives you different return drivers within your portfolio and different access to a different pocket of growth, because when you think about investing for the long run, you want to have parts of your portfolio that are moving in different ways, given the amount of uncertainty that is out there, because I 100% agree. The near-term outlook is a little bit cloudier, but when we're thinking about long-term expectations, we're using the type of volatility to lean into areas that have been on our watch list and using that volatility to take advantage.
Well, Sitara, hold that thought. You're sticking with us through the opening bell. We're just a couple minutes away, and here's your setup as we count down. The S&P 500 nursing a second day of losses if these pre-market losses hold, down about almost 1% before the bell. You can see that big tech is really leading those losses, with the NASDAQ 100 down about 1.3%. Small caps also getting caught up in the sell-off. We'll walk you through all of the opening action next. This is Open Interest.
We are moments away from the start of trading on what looks set to start as a down day. I'm Matt Miller. This is Bloomberg Open Interest. Futures off by 1% on the S&P after we closed down yesterday, ending a 9-day winning streak, the longest streak we've seen in 21 years. NASDAQ futures down even more sharply, 1.3% the drop there. You hear the opening bell on the New York Stock Exchange. You're going to see the NCAA women's basketball national champions. I see what looks like a Husky there, so I'm guessing it's UConn. If I look down at I don't really follow college basketball. If I look down the NASDAQ, 1-800-Flowers ringing the bell there. And this is a great reminder that this coming Sunday is Mother's Day. So think about that in terms of flowers. Katie, what stocks are you watching today unrelated to the holiday?
I'm still keeping an eye on Palantir, because quite a move that we're seeing, that sell-off accelerating after it raised its revenue forecast. Wall Street, as discussed, had very high expectations. You can see that Palantir shares now down by more than 10%. And Matt, this is worth noting because Palantir had been leading gains in the S&P 500 year to date. Obviously, some of the shine is coming off right now. Yeah, absolutely decimated there. Ford also losing a little bit of shine. It's just the latest automaker to suspend its guidance, saying tariffs will cost the company $1.5 billion this year before interest and taxes, citing, quote, industry-wide supply chain disruption. Let's dive into it with Keith Naughton. He covers Ford for us out of Detroit. And Keith, what do we need to know first about how damaging this is to Ford and how they'll be able to deal with it?
Well, I mean, Jim Farley, the CEO, referred to this as huge. The full impact, the gross impact from the tariffs on them is actually $2.5 billion, but they have found $1 billion in offsets. So this is really kind of messing up their planning. That's why they're not even giving guidance. They say they'll come back in the second quarter and give us an update, but they're even then not guaranteeing that they will have hard and fast guidance. Too many variables, Matt.
And this is interesting because, I mean, up until this point, Ford had been really resilient compared to some of its peers. Actually, looking at year-to-date gains, you compare that to GM, you compare that to Stellantis, Stellantis down double digits in 2025. I mean, in terms of how investors might be approaching this stock, what does this say about the rest of 2025?
Yeah, well, underneath this story on suspending guidance is the fact that Ford actually had a big beat in the first quarter. They were supposed to just break even because they're doing a big launch of their Expedition SUV, and instead they had an EBIT of $1 billion. So they're actually performing pretty well, finally cutting some of those warranty costs that have been a problem. But really, the tariff overhang really clouds over everything.
And tariffs would have a $2.5 billion effect, but they're offsetting about $1 billion of that. And I had to read this a few times in your story, Keith, by using so-called bonded transportation to shield parts from levies as they cross international borders. What does that mean? It doesn't even sound legal.
It doesn't, does it? Well, you've heard the story about car seats crossing the Canadian, Mexican, U.S. borders several times as they're being built because so many different parts come from so many different places. They have found a form of transit that allows those back and forth movements to be untariffed. So that saves them some money. The other way, Matt, they're going to save money, according to the analysts, is good old-fashioned price increases.
All right, Keith, really appreciate your reporting. That is Bloomberg's Keith Naughton. I will point out that Ford shares actually inching back to unchanged right now, Matt Miller. They had been down over 2% in the pre-market. It'll be fascinating to see how they settle up today.
And they're up year to date
yes.
as the broader index is down.
Yeah, exactly. So they've actually done okay in this environment, especially relative to some of their peers. But let's broaden out this conversation because still with us, I'm pleased to say we have JPMorgan Private Bank Head of Alternative Investment Strategy, Sitara Sundar. And I just want to ask the broad question. You think about this market, it feels like trade policy, tariffs, that uncertainty, it touches every single industry. But is there anywhere to hide right now? Is there anywhere that is really sort of insulated from some of the headwinds that we keep talking about?
So I think that it's difficult to say that because we don't know what the future policy in terms of like trade, fiscal, the confluence of different factors are going to be in the future. I think it's difficult to say that there's going to be one specific place to hide. However, I do think we were talking about this a little bit earlier, that there are ways in terms of how we're advising clients to create a portfolio that is resilient across market cycles. And that concept tracks in public markets and it tracks in private markets as well. And that's how we've been talking to clients. So what does that mean? On the portfolio resilience front, it's the international diversification point. It's the diversification within U.S. equity markets to ensure that you have growth and value exposure, tech and defensive exposure. And especially within the tech side, leaning a little bit more into software versus semiconductors, where the tariff and the looming uncertainty around what the tariff impact is going to be on the hardware side, coupled with the fact that we've seen a shift, or what we perceive to be a shift, from the hardware to the agency side and the application software side. So building resilience that way. But even when we think about the private markets and advising our clients, infrastructure is an area that we've been leaning into pretty heavily, honestly, for the bulk of this year and last year as well, because you have two different things. One, from a resiliency perspective, infrastructure tends to be pretty durable over time. You have inflation protection that is embedded within these really long-term contracts. And then two, when you think about these secular trends like artificial intelligence and the amount of money that is likely going to be inputted and invested into the energy infrastructure, digital infrastructure, and power part of the ecosystem, which is now 60% of global infrastructure, you have a secular tailwind, which I guess is maybe the tagline. We're trying to lean a little bit more into secular and cycle agnostic opportunities versus those areas that are a lot more cyclical in nature, where you're seeing companies pulling guidance because the uncertainty in that part of the market is a lot more high than in secular parts of the market.
How much size do you have access to in international private markets? And where do you think your clients should be building up positions?
So I think right now we're neutral. So if you think about how large international markets are within the broader MSCI ACWI or global markets, it's about 30%, depending on which index you look at. But our clients aren't there. Our clients have been meaningfully underweight non-U.S. markets, which, by the way, for the past decade was the right place to be and where we were advising folks to go, to be overweight the United States. But there are a lot of clients whose portfolios are not just overweight the United States, they are only in the United States. So we're having a lot of conversations with those folks now on adding to European equity exposure, adding to Japan exposure, which are not only just trading at a meaningful discount, not just to the United States, which I think is, there's structural reasons which we can get into as to why that valuation discount is there, but even trading below their historical discount. So there's some multiple expansion that we expect to see in both of those markets, but also one of the biggest reasons why we've seen this delta in performance between U.S. and non-U.S. markets over the past decade was a U.S. exceptionalism in the earnings and the mega cap tech companies being domiciled here. But we're expecting to see that earnings growth differential, even in the next 2 years, 2025 and 2026, start to compress. So you have a multiple expansion story and a secular growth earnings story as well.
Well, forgive my phrasing, but are clients buying that? Because we've been talking about the European, the rest of world outperformance for months now. And it seems like there's still this skepticism out there as to whether it's durable. There's been a lot of false dawns before, and I hear what you're saying when it comes to positioning, when it comes to valuation and earnings growth, but it just feels like still there is this hesitant to dip outside your home market.
Well, just look at what's going on in the Bundestag. That is not confidence inspiring, is it?
So I'll tell you this. Having been in this space for some time, the pushback to non-U.S. investing has been pervasive, and it's been there. And honestly, over the past 10 years, folks have been right to not do it in a meaningful way. However, the dynamics that we've seen within the U.S., when you think about what's happening with the dollar, what's happening with fiscal concerns, what's happening with policy-related uncertainty and speculation, and even what we've seen in real time on the U.S. trading like an emerging market asset in certain periods of time have, I would say, quelled some of the concerns and the pushback that we're seeing. Because even if you don't believe the secular story, the dollar diversification story is a big one too, and people are trying to diversify their assets outside of the U.S., so we've seen less pushback on that front.
But Sitara, how much of that pushback is just the way the infrastructure is set up? I mean, obviously there are private markets everywhere, right? But do U.S. investment banks really have access to private credit in India or private credit in Asia, private credit in Eastern Europe?
Look, I think the opportunity set and the vehicles are expanding across the board when you think about investing within private markets globally. But the biggest thing that I'll mention here is this, which is one of the biggest reasons why we talk about private markets. It's not just the secular growth opportunities that are there, not just within the U.S., but broadly, but also we're seeing a trend in the environment right now where there are more and more companies that are staying private for longer. And you've seen that a little bit in terms of the muted deal-making activity. There was a expectation for a resurgence of deal-making activity when you think about M&A and IPO activity coming into this year, that post-Liberation Day and post the uncertainty that we've seen in tariff and trade policy, that has become a lot more muted. But that idea of a majority of the companies within the United States being private, and therefore you want to make sure that you have access to the real economy at the end of the day, and private markets is a big way for our clients to be able to do that. That story exists within Europe and Japan as well, and like the APAC region, where a majority of the companies, even in those areas, not just staying private for longer, but a majority of the companies in those geographies as well are private. So when we think about portfolio resilience over the long run, ensuring that you have access to the actual return and earnings drivers across the board is going to be extremely important, and you need access to publics and privates to be able to do that.
All right, Sitara, we have to continue this conversation soon. Really great to see you. That is Sitara Sundar of JPMorgan. Meanwhile, we have some other movers on our radar because DoorDash is buying British delivery company Deliveroo, as well as U.S. restaurant hotel reservation company 7 Rooms. You can see shares down almost 8% or so as traders digest some of the price tags there. Mattel, this is a really interesting one. It actually pulled its 2025 forecast, citing tariff impact on toys. You can see shares managing to rise just a little bit after the opening bell, up 0.7%. And then AMD pushing forward. AMD reports after the close, giving us an update on the AI chip race. You can see shares down about 2% right now, Matt. I'll note that they're down about 18% so far in 2025, underperforming the SOC. So a really pivotal moment for AMD.
All right, coming up, we are going to be live from the Milken Global Conference in Beverly Hills again, this time joined by Blue Owl co-CEO Marc Lipschultz. And happening right now, German lawmakers are voting again on the next chancellor hours after Friedrich Merz didn't get enough votes in the first round. You can continue to follow the vote in real time by going to Live Go on your terminal. You can see those Germans casting their votes in a secret ballot. This is Open Interest.
I'm Sonali Basak, and this is Bloomberg Open Interest. I'm here at the Milken Institute Global Conference in Beverly Hills. Joining me now, Marc Lipschultz, Blue Owl co-CEO and co-founder. And it's an interesting time to talk to you, Marc, because you heard it from the Treasury Secretary. He's got his eyes on private credit. More activity has moved out of the banking system into firms like yours. What did you make of his remarks?
Well, it's great to be. I couldn't be in a better place than with you at Milken, and what incredible people here talking. You know, I think the role of private credit, which is acknowledged in those remarks, is a good one for the economy. Of course, we want a healthy banking system, and you and I have talked about this. We're happy to have the banks in the market and be active, but private credit has clearly proven its mettle and proven its worth. We are a big part of stabilizing available capital in the marketplace. And you can see it over the last 5 years. Every time there's been a meaningful disruption, and the public markets, even this last month, right? We had syndicated markets go for the longest time in 10 years without launching a syndicated transaction. We're open for business, we have capital, and we're lending.
Well, to that end, it's interesting. A few days ago, you had told me, when I asked if there are restructuring opportunities, will you step in? Will you step in with large dollars into those types of financings? And you unequivocally said yes. So my question is, how much do you think you're going to be deploying this year in terms of helping companies navigate this storm?
Yeah, and I love that phrasing, because that's the way we often talk about it. It is about navigating the storm. And storms come and storms go. They may be severe, but the key, of course, is to navigate to the other side. So we're very available, very front-footed. We're lucky because our portfolio is in great shape. So we start from a really healthy place, and we have a lot of capital to invest. So we'll be very active. Now, the question, of course, will be how big is the storm? And that's hard to know, but that's also, again, from a Blue Owl point of view, sort of why we exist, which is to deliver for investors results that are stable, predictable, protected from that kind of storm.
But what type of storm do you expect?
You know, look, sitting here today, trying to be bottoms up and data driven, at this point, things are still going well. Our companies are still performing well. Now, we're a very domestically focused firm. So I always like to acknowledge, one's perspective obviously influences, the view. And so from where we sit, we have most software is a big part of our business. Software doesn't have a supply chain. We have insurance services. We have business services. We have healthcare services. And so these are really domestic-oriented businesses that are less impacted by the sort of vicissitudes, magnitudes, timing of every trade deal. Now, of course, the global economy affects our business. But sitting here today, companies are really healthy. I looked at last quarter, and on average, the EBITDA growth in our portfolio was higher last quarter than the quarter before.
So let's talk more about the potential impact here of tariffs, because over and over you're seeing one CEO after another say, okay, we're getting a clearer picture generally that tariffs will be higher, that they might be lower than those initial Liberation Day shocks that we saw to the system. Where do you think this ends up? How do you plan for it? And do you like it?
So I'm hopeful that we will see some trade deals. And I don't think it's overly optimistic to say soon. And of course, we heard that from the Treasury Secretary and other officials from the administration. There's clearly a lot of dialogue going on, and I think some early trade opportunities with Korea or with India would be really significant to advancing us down this next phase of the post-Liberation Day resolution.
So it's interesting because when you hear the words from the Treasury Secretary, a lot of Wall Street has taken a lot of confidence in him. They have really hung their hat on his plans. Now, it's interesting. The bond market is actually telling a different story this week. You had a 7-day decline in the 10-year, and then you've had a 4-day increase. We're watching day by day now because it is reacting. It's maybe the most important barometer these days of what's happening with the administration as it pertains to Wall Street. 435 on the 10-year is where we are today. If you were a betting man, is that higher or lower in a year from now?
So I've built a business on not being a betting man. So I've built a business on saying, you know what, it might go up, it might go down. I promise you I don't know which. It'll be one or the other. But I don't know which. And our business is built to thrive either which way. So I mean this in all due candor. I try not to take the view, because I don't trade that view. Is it going to be 435? Is it going to be 444? There's some people, I'm sure, that are very skilled at doing that. I think it's hard to do. But I think you can build around a range of reasoned outcomes.
Reasonably, too. You do benefit. Your business does benefit when rates are higher, right? So it's not a problem for you per se.
That's right.
But do you think that what we're seeing right now would yield a higher rate environment? I mean, we're not just talking tariffs here. We're talking about tax policy and the fiscal deficit as well.
Yeah. Well, look, we're in a what I hope will prove to be a continued strong economy. We have some uncertainty here. We have this storm that we have to get through, but I hope it'll be continued strong economy. That would certainly align with generally higher for longer rates, and that would remain kind of an overall view. So whether that's higher or lower than 435, I don't know. But what is notable, not to be lost in all this, and the audience knows it well, but 435 is a pretty normal number. It's only because we all lived for years and years and years with like wild numbers like 0 that this seems high-ish. 435 is actually not far from the long-term average.
You know, it's interesting. We've heard a lot from administration officials over the last couple of days. By and large, what do you think of the policy? Do you buy the strategy?
Look, I understand the need to reform trade. I understand the need. I come from a school of thought that certainly sees the power in trade, but that's about fair trade, and I understand the need to modify and make changes. So again, look, I'm hopeful that this move forward and some new deals in the foreseeable future will start to bring us down the track that I think is the strategy the administration has in mind.
You know, later today, I'm moderating a panel here on the future of capital markets, and everybody on that panel has asked me to ask about the long-term view, the 5 years, the 10 years. What decisions are you making today that will determine the way you underwrite for the next several years on the heels of this new order for the world?
Well, look, that's a great way to phrase it, because we're in the long-term investment business. You know, the short-term turbulence, that's part of what we're built to just see our way through. So long-term, looking multiple years out, most important for us, we invest at the company level, right? We're not macro investors, so it's the bottom up. So what we're looking for are places that are going to be stable and predictable. So there are macro trends. Let's take, the AI revolution. It's real. There's going to be some really interesting things on the cutting edge, but I don't know which of those will work. What I do know for sure is that there's hundreds of billions of dollars needed to invest in the infrastructure, the data centers, and that's where we specialize, the hyperscale data centers that will underpin this AI revolution. That's something I can say, looking out 3 and 5 years, I feel highly confident that is going to be a significant demand center for capital, significant demand opportunity for the users. And these users, like the Microsofts of the world, the Amazons, are fantastic partners for us. So that's the way we kind of look at the long term. Find things we can be really confident about and build safe strategies around them.
Marc, really good to see you this morning. That is Marc Lipschultz of Blue Owl, setting the stage for another very busy day here out in Beverly Hills. Katie, back to you.
All right, our big thanks to Sonali Basak and to Marc Lipschultz of Blue Owl. We'll have plenty more interviews from Milken throughout the day, including John Gray of Blackstone, Katie Koch of TCW, and Jenny Johnson of Franklin Templeton, just to name a few, Matt Miller.
Yeah, we're going to be watching very closely what comes out of Milken. Also watching the Bundestag right now. Germany voting. You saw those lawmakers lined up, putting their ballots in the box. Let's go back to Oliver Crook right now. He's standing by in Berlin. So, Ollie, how soon will we have a verdict?
So listen, we're expecting a verdict potentially within the next 20 minutes or so. And just to sort of recap for the audience here who might not be familiar with the procedural politics of getting a new chancellor in Germany, and we have to say that a lot of people in Germany were not familiar with it because it has never happened before to have the chancellor, basically the coalition agreement, the chancellor put before the Bundestag at the very last moment and have that vote failed. And that is exactly what happened this morning. And so they have now had several hours in which they were debating whether or not they could have another vote today. Potentially, they thought it was going to delay it to tomorrow or later in the week. They are now reconvening. They are now currently voting to try to get the CDU chancellor to be Friedrich Merz through this parliamentary process. Now, we should say that the fact that this vote failed means that some people within the coalition government, either from the SPD or the CDU, did not vote for the agreed chancellor. We do not know who yet. We do not know sort of what the political message here, whether it was from the SPD who were not happy with some of the compromises, the left of the coalition. Was it from the right, the further right wing of the right part of the coalition? We don't know the answer to that. All that we know is that this was supposed to be the day that ushered a new era in for the political German establishment, one that took us away from high instability from a free party coalition into this two-party coalition of stability, of fiscal spending, and dealing with all of the challenges with the German economy. And that did not happen today. We'll see if it happens in the next 20 minutes.
All right, Oliver, appreciate your reporting. That is Bloomberg's Oliver Crook joining us from Berlin. You can continue to follow the vote in real time by going to LiveGo on your terminal. Meanwhile, a quick check on these markets. The S&P 500 down over 1% right now. We're hanging out near session lows. It's a wipeout across the board. On the S&P 500, only 62 stocks in the green right now, Matt. So really broad breadth when it comes to this sell-off.
Yeah, we had breadth on the way up, and now we're looking at breadth on the way down. I wonder if there's an opposite of the swag breadth thrust indicator. We come back. Treasury Secretary Scott Bessent is set to testify at a House Appropriations Committee hearing. We're going to bring you that live in the next hour. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is at the Milken conference in Beverly Hills. And let's take a look at the live shot of Capitol Hill, where Treasury Secretary Scott Bessent set to testify at a House Appropriations Committee hearing in just a few moments. We'll bring you to that momentarily. But let's get a quick check on these markets right now because the sell-off is continuing. The S&P 500 down by about 1%, not quite session lows, but pretty close. Really bad breath in this market. Good breath in terms of all the stocks are moving together. Bad news, and it's to the downside. Big tech are leading a lot of those decliners, with the NASDAQ 100 down about 1.5% right now. But a small silver lining, Matt Miller, the bond market pretty quiet right now, with 10-year Treasury yields pretty much unchanged.
All right, so we do have a big drop in equities, not a lot of move in treasuries. That could change as we get Scott Bessent's remarks. We're going to bring you the Treasury Secretary as soon as he begins speaking. In the meantime, let's get back to Sonali Basak at the Milken conference in Beverly Hills. She's joined by Carlyle's head of global credit. Sonali?
Yeah, thank you, Matt, so very much. Yes, I am joined by Marc Jenkins, who oversees the credit business at Carlyle. And credit has definitely been the name of the game here at Milken. It's where the roots are of this conference, after all, and it's also the heartbeat of the American economy in a lot of ways. How do you feel about this moment in time? Obviously, tariffs have been causing a lot of anxiety. Do you find that to be overwhelming for the investment community, or do you find it to be something that they're actually finding a lot of opportunity in?
Well, I think if you step back, I think the tariffs right now are just temporary noise. I think the foundation of what we've been looking at, the trends that have been changing, really started post-COVID, which were, reshoring of critical supply chains, redesigning your supply chains, if you will, in the face of what we saw during COVID, and then also realigning some of our global alliances as it relates to trade. And I think the fourth thing that's happened that people aren't taking into account right now is the advent of AI that happened. So all those trends were happening. Tariffs are really just accelerating some of those trends that we've already been experiencing for the past 5 years.
So what does that mean in terms of how you map out your year and the way you're planning on deploying capital? Is it a pause kind of moment like so many CEOs are talking about?
Well, I think right now the moment in time is maybe call it the 3 Ps. People are pausing. right? People are preparing because we think there's opportunity, and then we're going to prosecute in opportunities that we think that make sense in the context of a very wide range of outcomes that tariffs are causing. That uncertainty that everybody's talking about creates a very wide outcome, a bandwidth of outcomes, if you will.
So what does this mean for the cost of financing moving forward? We've been talking to a lot of people about the 10-year, Scott Bessent's favorite kind of gauge here of how the markets are looking at the plans moving forward from the administration. 435 on the 10-year. Higher or lower for the direction of travel moving forward?
I'm not good at predicting where treasuries are going to go. What I would say is I think we're surprised at how tight credit has remained. I mean, we're basically back to April 2nd kind of levels, if you will. And I think that has to do with a couple things. One is what's happened in the past 5 years in terms of corporates getting themselves kind of back in shape from a balance sheet perspective. If you look at where leverage is and where interest rate coverage, it looks pretty good, close to pre-pandemic levels. I think secondly, you haven't seen so far in the numbers a sharp drop off with respect to economic growth, and I think that's probably buoying things a little bit. But we would expect, if there's a slowdown, that levels are going to change over time.
Are there places of the economy that you're avoiding right now, given the potential pressure of tariffs?
Yeah, I think it's very difficult in the retail space. I think it's very difficult if you're a distributor that's reliant on imports specifically from China. I mean, autos and auto suppliers right now, the uncertainty around that, those are kind of areas where historically we haven't really played anyways, but I would say would avoid right now.
So what does this look like for private markets? A lot of people have a lot of questions about what marks look like under the surface with the whipsawing of public markets. We talk about this a lot.
Yeah.
I know you have some skepticisms on some of the numbers that we're seeing out there in terms of how bad things might get.
Well, I think that, when we think about private capital and what function that performs, if you will, in the overall economy, private capital has, as you know, grown over time, over the past decade, if you will. And that's a good thing for the ecosystem because you have more sources of capital. All of the changes that we're talking about that are occurring in the global economy require more capital, and in fact will play to the strength of private capital. Now, the cost of that, in theory, should go up because there's more demand. But I would say private credit, private capital, private equity is well placed to take advantage of the changes we're seeing. I think the underlying marks that you're getting to, I think all of us, by and large, have a lot of oversight with respect to what we have to publish because a lot of us have public vehicles out there that have daily marks out there. So, I know people talk about that as being a big issue. I'm just not 100% sure that's completely correct.
So do you think that there could be bigger issues ahead? One thing people talk about a lot, and you've seen it happen over the course of the last couple of years, private equity firms, they haven't been able to exit investments. There hasn't been a whole lot of M&A either. Yeah. These are all places that tend to be the lifeblood fuel for the private credit markets, if you will.
Yeah, what's happened really in the past, I'd say 5 to 7 years, is what I would call private credit. The definition of that has expanded greatly, right? So you've seen a huge expansion into asset-backed finance, investment-grade private credit, which really doesn't rely on M&A activity. I think, what you're talking about is I would say today is a relatively narrow, slice of what overall I think of as private credit. Some people define that as 23 trillion plus. And in that kind of venue, direct lending in sponsor activity is a small sliver of that. So I think there's a lot of activity out there today for investors.
So from where you sit, where is it exactly that you want to be operating? Are you pushing more and more away from that traditional direct lending type into more asset-based? You've obviously at Carlyle done some massive deals in the asset-backed space.
Yeah, I would say, look, we're always going to be focused on that element. That's cornerstone to almost anybody's private credit business. But I would say the non-sponsor business has been very lucrative, very attractive for us in terms of our ability to pivot there. And I would say asset-backed finance for us and others is an area that is growing, and it's growing quite dramatically, if you will, in terms of access to that marketplace.
Marc, talk to me a little bit more about the dynamics you're seeing through the course of the year. We talked a little bit about potential capital deployment, but really what I want to know is what types of opportunities are you looking for, given all the tumults under the surface?
Yeah. Right now, until that M&A activity picks up on the sponsor side, that's just not happening, right? Ideally, we're all expecting that'll happen. I'm not going to predict when that's going to happen. We still see a decent amount of activity, especially in Europe, on the non-sponsor side, where the banks have retrenched, if you will, for what we consider to be relatively large, well-capitalized, family-owned, founder-owned businesses that aren't sponsor-driven, and we've been working a lot there. Direct lending in Europe has actually been more attractive than in the U.S., and asset-backed has continued to be an interesting area as that market is just really opening up, I think, on the private side.
It's interesting. I'm glad you mentioned Europe because it's been a big topic here. Investing not just in the United States, but outside of the United States. Right. The promise of Europe has come up a lot. How do you feel about it?
Well, I think there's two ways to look at that, from the equity side or the credit side. I think I won't speak to the equity side. I certainly would say from the credit side that it presents a lot of really interesting opportunities because it's not one unified market. You have multiple markets there with multiple participants on the finance side, and that makes it so attractive because it's much more fragmented. And I think our ability to pivot into the companies that have global exposure that are based in Europe is really attractive for us.
Now, Marc, I want you to make a comment of the market overall. Frankly, a lot of people have not been through a severe downturn, at least as bad as 2008. There have been, of course, the COVID downturn as well as the Silicon Valley Bank crisis, but a lot of people have not really managed through a full business cycle in this industry. You've managed through several.
So you're saying I'm old, I think is what you're saying.
No, I just think in private credit in particular, what are the lessons to be learned here for people who are much newer and frankly considered tourists to the industry?
Yeah, I would say so. You're right. I started as a credit analyst 35 years ago and have been through various cycles that weren't, talk about pre-GFC where we didn't have massive monetary stimulus to keep rates at zero. I mean, we did go through normal cycles. And I think what's happened over this period of time is in larger organizations where you have the capabilities not only to, make portfolio decisions, make credit decisions, but also when you have to go through a downturn and deal with running a company, taking ownership, and realizing on your collateral, those are different skills that haven't necessarily been tested over the past 14 years. And I think in larger organizations, when you can rely on, your private equity business that has operating partners and we own companies, I think that'll benefit investors going forward if you're working with large asset managers. And not just us, there's many of us out there that do that.
Right, this is to say that if things get really bad out there, you might have to take control of the company.
Correct.
And then all of a sudden you're an asset owner instead of a lender.
Correct. And at the end of the day, we're going to create value by taking charge of that and realizing on our collateral in a more productive way than just selling at a distressed value.
Brushing up on new skill sets for new investors. Carlyle's Marc Jenkins, thank you so very much for joining us. Katie, back to you.
All right, our thanks to Sonali and Carlyle's Marc Jenkins. And as we've been speaking about, let's go now live to Capitol Hill, where Treasury Secretary Scott Bessent is speaking.
Tax cuts and cost savings from deregulation raise real incomes for families and businesses. Tariffs create an incentive for reshoring jobs and fair trade. And deregulation complements tariffs by making it easier to invest in energy and manufacturing projects. Already, this agenda is bearing fruit. In the first 100 days of the new administration, 464,000 new jobs were added to the economy. In April alone, over 177,000 American jobs were added, more than 40,000 more than economists predicted. All the while, unemployment remains low while real hourly wages continue to grow. As important as spurring job growth is wrangling inflation. And in this endeavor, the administration continues to make tangible progress. The CPI for energy goods declined in March, as did the price index for core goods. And the CPI for all items declined for the first time since the COVID pandemic. While the cost of goods is decreasing, so are energy prices. Complementary to our efforts to grow American prosperity, we are focused on improving efficiency across all levels of government, but especially the IRS. We just concluded a successful tax filing season, but the IRS still needs significant reforms to deliver efficient and cost-friendly results for the American people. In this endeavor, we have successfully cut $2 billion from the IRS IT budget without any operational disruptions. We achieved these cost savings by eliminating, renegotiating, and de-scoping wasteful IT and professional services contracts and addressing long-standing inefficiencies, such as auto-renewed licenses unused for years. This intervention alone will save taxpayers hundreds of millions of dollars each year. We are also taking steps at the IRS to reduce administrative costs with a particular focus on paper processing, which has been a long-standing bipartisan goal. Last year, the IRS spent approximately $450 million on paper processing with nearly 6,500 full-time staff dedicated to the task. Through policy changes and automation, Treasury aims to reduce this expense to under $20 million by the end of President Trump's second term. In addition to making government more efficient, Treasury is committed to working alongside the White House to make America safe again. To that end, we have launched a maximum pressure campaign against violent cartels and terrorist networks. We have assessed tens of millions of dollars in civil penalties against organizations facilitating money laundering along the southern border, and by leveraging sanctions, we are choking off the financial lifelines of terrorists, criminals, and hackers from Mexico and Guatemala to China and Iran. In the first 100 days of the new administration, we have set the table for a robust economy that allows Main Street to grow. With Congress and the White House working hand in hand, we expect to see even more positive results over the next few months. Key to expanding economic opportunity for all Americans is making the Trump tax cuts permanent. We look forward to working closely with the members of this committee to pass this bill into law. Together, we can build a stronger, safer, and more prosperous America. Thank you.
Thank you, Mr. Secretary. I now recognize myself for the first questions. Secretary, let's fast forward a year. Where do you see the U.S. with respect to tariffs and the overarching strategy? Do you anticipate all trade deals being bilateral, or could there be multi-country trade pacts of which groups of countries agree to a tariff schedule?
Mr. Chairman, this will be path dependent on our trade partners. As I've said before, there are 18 very important trading relationships. We are currently negotiating with 17 of those trading partners. China, we have not engaged in negotiations with as of yet. So I expect that we can see a substantial reduction in the tariffs that we are being charged, as well as non-tariff barriers, currency manipulation, and the subsidies of both labor and capital investment. So that is proceeding very well. Many of our trading partners have approached us with very good offers, and we are in the process of renegotiating those. With the economy, I would say that this is a three-legged stool: trade, tax, and deregulation. Trade was first. The House, according to Speaker Johnson, expects to move their portion of the bill over to the Senate on or about the Memorial Day, so we're looking forward to that. And then deregulation necessarily takes longer to affect the economy, but I would expect in the third and fourth quarters, we would see substantial benefits from deregulation that by this time last year could be in full force.
We've seen a few numbers discussed in terms of how many countries with whom you have started tariff negotiations. What is the actual number, and what is the status of those negotiations? How many deals do you anticipate by the end of the year, in the first quarter of 2026 or the second quarter? And what are the biggest challenges you see to negotiating tariffs and getting trade deals done?
All right, we're going to take a quick break from that testimony to get over to the Bundestag, where news is breaking that the German parliament has finally backed their leader, Friedrich Merz, as Chancellor. Let's get over to Oliver Crook in Berlin. Oliver?
Yeah, so listen, Matt, this is the sort of second take on the vote that happened first time this morning. And remember, the first vote was supposed to be a rubber stamp, no-brainer. And actually, at this time today, we expected Friedrich Merz to actually already be Chancellor of Germany. That obviously didn't happen. They managed to fail, which means that not all of the coalition had voted in favor of Friedrich Merz. So there was that big failure. They now had the take-two vote. And we now have a sigh of relief for the German political establishment with Friedrich Merz that has been now voted Chancellor of Germany. The next steps now, he will go consult with the President of Germany, who will consult there, and then he will come back to the Bundestag in order to be sworn in. After that, his cabinet will be sworn in. But we should say that despite the fact that this eventually got over the line, this does create some damage politically to Friedrich Merz in the sort of position not really being as strong as very much he would like to be, and the CDU and the SPD's coalition would like to be at a moment now when Germany is dealing with all of these massive issues, whether it's the tariffs and Donald Trump, whether it's working out new trade agreements as a consequence of what they're dealing with Donald Trump, whether it's the fact that it's been an economy that has been in contraction for 2 years and potentially could be in contraction for a third year, and to also deal with the domestic issue that has been the main focus of this political campaign for many people in Germany, and that is immigration. The question is, how strong is this chancellor, and how fast can he hit the ground running in trying to deal with all of these issues?
Yeah, well, as our top live points out, that some of the things you went through, Germany's economy is stagnating right now. You also have support for the far-right Alternative for Germany strengthening right now, Ollie. It seems like, okay, maybe there's a sigh of relief right now. He got through this vote finally, but we're going to see more run-ins along these lines.
Absolutely, and this is by no means a sort of clean and clear sort of path for this leadership, right? This is the AfD, the Alternative for Deutschland, the right-wing political party, and we should say that 4 days ago or so, that the sort of the German, the agency that is one of their spy agencies that's supposed to protect their constitution, basically ruled officially the AfD an extremist party within Germany. They are now polling, since the election back in February, as the #1 party in some of the polls in Germany, and the sort of charge that they have made against the German political establishment and against the mainstream parties is that basically they are a failure to get anything done. They can't get things done over the line because there are these uncomfortable coalitions. There was another example of that today in the failure of the first vote. So as you say, this is going to be a continuing political debate. What Friedrich Merz needs to do is consolidate power here within Germany, start to build a presence on the international stage, which Olaf Scholz really failed to do both at the European and the global level, and really get some of that money deployed, that €1 trillion in stimulus across defense and infrastructure, start to put that to work to turn the economy around.
Is the problem that there are too many factions at this point, Oliver? I mean, we just saw Friedrich Merz sitting next to literally his right-hand man, Jens Spahn, and the two of them are pretty right of the rest of their coalition, right? But they're not the Russia-backed right that the AfD is. Meanwhile, they were, I guess, defeated by some SPD members who are pretty left for their coalition, but not as left as the Russia-backed far left. So it seems that there are, two lefts, two rights, and not a very big center.
Absolutely. I mean, this is one of the main issues that you have here in Germany, is this absolute splintering of the political establishment. We've seen it all over the place. I mean, listen, we will say, though, Matt, that since your days of leaving Germany, this is not Merkel's CDU anymore. This is a much more conservative party than it was under Angela Merkel. And yet, as you point out, it is not conservative enough for many Germans. You have basically the CDU and the AfD polling at the same level at 25%. Again, a lot of that has to do with immigration, but it's some of also the sort of what we've seen across the political spectrum in the United States. A lot of the MAGA vote, a lot of the vote for Donald Trump was not necessarily a full endorsement of that ideology, but this concept that these mainstream political parties are not effective at getting things done and affecting the lives of the people within the nation. And that is certainly one of the narratives that you have here generating here in Germany.
Ollie, I want to go back to how this happens. Let's go back to the initial vote, because he had only managed 310. In the initial tally, he needed 316. The second time around, he got 325, so over the line there. But this was a secret ballot, so we don't know who actually didn't vote that was expected to vote. But there's plenty of conspiracies out there. What is the current thinking?
Yeah, so listen, Katie, I think this is exactly the point. It's like, where is the actual weakness in this arrangement? Did it come from the left? Did it come from the SPD, from people who basically wanted to sort of mark they're not terribly happy about the situation, but you know what, they'll get it over the line eventually? Again, this is the kind of game that you've seen a lot in German politics, and it's the kind of game that really does not play very well at this period of time. I mean, you talk to a lot of people within Germany, and they get very frustrated. A lot of the people in Germany, a lot of the politicians deal with a lot of these issues and are completely uncompromising. surprising. For example, the one thing that the AfD sort of rails on about a long time, and something that there's been a lot of criticism about, is that Germany shut down all of its nuclear power because the Greens wanted it. They were part of the coalition in the middle of an energy crisis. So there is oftentimes criticism within Germany that there is a lack of pragmatism within the political establishment, and that, again, potentially was on display again today. There have been also some thoughts potentially that this could have come from the far right of the CDU party, that actually potentially some members would actually like to see working with the AfD because they say that there is more overlap. We should say, however, that the CDU has categorically said and ruled out working with the AfD, but potentially looking years into the future about how this develops in Germany, we don't know how long that firewall can really hold.
Yeah, I wonder. We just were looking at pictures of Alice Weidel and Alexander Gauland, their AfD leaders, lining up to shake hands with now Chancellor Merz. Why do they rule out working with the AfD so categorically, especially if the two are polling, the CDU and the AfD, so well? Is it simply the Russia issue that divides them, or what is the main issue that sets them apart?
Listen, I think the main issue, Matt, is basically in the wake and sort of aftermath of the Second World War. It is very sort of difficult for anybody in Germany, for the mainstream, to get on board with far-right politics. Of course, the AfD would say that that is not the party, that is not what they represent. But as we were just mentioning, one of the spy agencies that has basically declared the AfD an extremist parties, they did that on the grounds that the idea that at the heart of the AfD, and this, we don't have the full report from this agency, it probably would be helpful to get more of that in order to understand their thinking, was that basically the AfD does not consider people that are in Germany from different ethnic backgrounds, even with German passports, they don't consider them as equal citizens. Now, of course, this is something that the AfD has denied, and this is something that the AfD in sort of the mainstream figures like Alice Weidel that come out and talk about what their policies are completely deny. But this is basically what the spy agency here in Germany has said, and that they are effectively a threat to democracy and the Constitution. But this, Matt, is a live debate, and I would have to say that from the time when you were living in Germany, this taboo of not voting for the AfD has evaporated for many people, particularly in the east of Germany, but they've never done as well as they're doing today.
We're just looking at Friedrich Merz now, about to shake hands with Alice Weidel, the blonde woman standing there to his left, and Alexander Gauland behind her. So it'll be interesting to watch these relationships develop and see, if they can hold that firewall between the centrist and far right and far left parties. Oliver Crook, thanks very much for your coverage out of Berlin. Germany has a new chancellor, and he is Friedrich Merz. Let's get back now to U.S. politics, really global trade. Treasury Secretary Scott Bessent is testifying at a House Appropriations Committee hearing. Let's listen in.
For being here today in front of my colleagues, I'm going to ask a question that I'm sure you've never been asked before, but I'll give it a try here. When is X date?
Congressman, we are, as I said earlier, we still take in a large amount of the paper returns. So every Friday, I get a summary, and if you can believe it, as you know, tax day was April 15th. We are still tallying that, so that we will share with Congress when we believe we are approximating that date. So that will be forthcoming. But I will tell you, just as an outfielder running for a fly ball, we are on the warning track. And when you're on the warning track, it means the wall's not far away.
So it's not today, may not be next week, but it is fast approaching.
And of course, the United States government will never default. That we will raise the debt ceiling, and Treasury will not use any gimmicks. We will make sure that the debt ceiling is raised.
You have already answered a couple of questions about the president's budget, and I'm going to ask maybe a little differently. The president's budget request for fiscal 26 looks very different from President Biden's budget just last year, and I have been a longtime proponent of getting our fiscal house in order, and I applaud the president's attempt to get our fiscal house in order. During my tenure as chairman of the House Budget Committee many years ago, I co-chaired the Joint Select Committee on Budget and Appropriations Process Reform, and many of our recommendations are included in Trump's request. It's no secret we're heading toward a big and needed change within the federal bureaucracy. That said, his budget request for the Treasury is $11.5 billion, compared to FY25 enacted at 14.2. Now that's a 19% decrease. You've already mentioned that we have savings achieved in contracts regarding IT services and this sort of thing, and we've saved the American public a lot. But you've also said that IT remains one of our biggest challenges, particularly within the IRS. So how is it that you're going to operate with a smaller budget that still serves the needs of the American people?
Sir, part of that has been bringing people back to the office. So on March 10th, we reinstituted a work from your office program. And again, I think it's going to be efficiency. We have asked for more money for many of the priorities. The Treasury Foreign Intelligence Network and the Office of Foreign Asset Control, OFAC. So we will be keeping the American people safer. And again, we think through efficiency gains, the federal government historically does not have productivity increases. And as I've continually pointed out, DOGE is the Office of Government Efficiency, not the Office of Government Extinction or Eradication. So I think that it is not a big leap to do much more with less.
Are there $2.5 billion worth of efficiencies?
Well, again, just two of it is in the IT department. And if you were to look, Treasury processes about 1.5 billion payments per year, which is like a mid-sized U.S. regional bank. We have had many of these banks come in and talk to us about their payment programs, and their departments are 1/10 the size and 1/10 the budget. So allowing for the redundancies that we would need as a government agency, then we think that we do need to be bigger and more fulsome, but there are substantial savings to be had.
I want to ask one more quick question, because I know we're probably not going to have a second round. You have been a proponent for better financial literacy in this country, and your background is, is evidence of that. Quickly, can we do a better job in this country of educating young people on matters of financial literacy?
Sir, any increase that we do would be a better job. We just hosted Financial Literacy Month at the Treasury. I only had 2 months to get ready for it. I can tell you that every April we're going to do more and more. But the key to financial independence is financial literacy, making good choices, and not, I don't think it comes from more regulation. I think it comes from more financial education.
Thank you very much.
The chair now recognizes the gentleman from Wisconsin, Mr. Pocan, for 5 minutes.
Great. Thank you, Mr. Chairman. And thank you, Mr. Secretary, for being with us. My main concern is, I think, what people are looking at the economy. The first 100 days, lowest stock market since Richard Nixon, not usually a measure people are shooting for. On tariffs, the fact that last year we had an effective rate about 2.5%. I think the Yale Budget Lab, and I believe you went to Yale, has said that effective rate is closer to 28%, the highest since 1901. I know that some of that's changed because the tariffs are on again, off again, some on again, some off again. Somewhat chaotic, I believe, as your term is what, Crazy Ivan style. I compare them to how a monkey throws dung. You're not exactly sure where they're going to land. And that's the concern I have as a small business owner, and I know Ms. Glusenkamp-Perez is as well. I've got small businesses really worried. You made a comment about while cargo volumes have dropped 60%, you see this as a temporary detox. But for a small business that's getting by day to day, that's much bigger. You talked about Main Street We want to finally focus on Main Street, not Wall Street. I think you were at a global investor conference in Beverly Hills yesterday. That's the cocktail party where you mentioned the crazy Ivan theory. And before that, you were at a JPMorgan Chase World Bank private investor summit. All those things are not Main Street, right? Main Street is an auto body repair, a specialty printer. So my concern is on the tariffs. Who pays tariffs, Mr. Secretary? No. Answer the questions I asked, please. I only have 5 minutes. Who pays tariffs?
Sorry? Well,
who pays tariffs?
Sorry,
Mr. Secretary, please.
Excuse me.
The question is very simply, who pays tariffs, Mr. Chairman? I'd like him to answer that question.
Well,
he wants to answer other questions.
Well, Congressman, if the exporters, they dislike tariffs so much, why wouldn't they? If I think what you're trying to get me to say.
Did you remember the question? I'm not sure you did. Who pays tariffs?
It's a very complicated question.
Reclaiming my time. People pay tariffs, right? Reclaiming my time, Mr. Secretary. Reclaiming my time, Mr. Secretary. Reclaiming my time. You clearly aren't going to answer it. I'm not going to waste my time having you go, Mr. Secretary, reclaiming, Mr. Chairman, I asked reclaiming my time.
Tariffs.
Mr. Chairman. And I asked to reclaim my time. Did I not? No, I said reclaiming my time because he's clearly not answering it. So, yeah, so as a small business owner, and unfortunately I'd like that time back since you failed to recognize me for 30 seconds. So I just recently from one of my suppliers got the tariff surcharge on things. And in addition to the tariff surcharge, guess what else got raised? American-made walnut plaques. That has nothing to do with tariffs, but companies take advantage and do that. So right now, we are getting screwed right and left because of the indiscriminate use of tariffs. That's the reality for Main Street. And you go off to Beverly Hills for private investor conferences and talk about crazy Ivan theories. Answer that. What is the crazy Ivan theory of tariffs that you mentioned at the summit?
Well, first of all, sir, I've had meetings with more than 50 small lenders. So I want to clarify that. I would also say that in game theory, strategic uncertainty, of which you seem to like the name Crazy Ivan.
Well, it's your words, correct? Didn't you use Crazy Ivan at the...
Well, you've used it 5 times. And
that's the question, Mr. Chairman.
I am saying the strategic uncertainty is part of negotiations. That should we say, here's what we'll accept. Please take this.
Okay, I've got your answer. Thank you. I'm going to reclaim my time again. So for a small business, we don't have that luxury, right? When the ports are empty in California and we can't get goods and people are stocking up for Christmas goods, Crazy Ivan is great for, please don't take this offense, really rich people like you. But for people like me, it's not, right? That's what makes small businesses fail. That's what makes people lose their jobs. That's what makes the stock market tank. So I'll ask one more time, who pays tariffs?
Sir, the history would show that it is a complicated mix of who pays the tariffs over various times.
So that's exactly the problem. If your answer, and you are a very educated person, you have a very impressive bio, cannot answer the question who pays tariffs because you won't answer that, and you say it's a complicated issue, it's not complicated. Consumers pay Trump's tariff tax. That's the reality. And I'll yield back, Mr. Chairman, but I do think next time if I ask to yield back, I would appreciate having my time yield back.
Chair now recognizes the gentle lady from Iowa, Ms. Hinson.
Thank you, Mr. Chairman. Good morning, Mr. Secretary. Thank you so much for taking the time to come and answer our questions. I appreciate what the Trump administration is doing to try to level the playing field for American consumers and restore our economy to where it needs to be. So I really appreciate the work that you were doing to make that happen, Mr. Secretary. And I certainly, as an appropriator, recognize the importance of making sure that every tax dollar is spent appropriately, and I appreciate your opening comments as such. So with that, the GAO estimates the federal government loses between $233 and $521 billion annually to fraud. Those are alarming numbers, hard-earned tax dollars just wasted. President Trump has certainly acknowledged the absurdity of this level of waste, and he signed Executive Order 14249 to protect America's bank account against waste, fraud, and abuse. And I was proud to support this effort by introducing a piece of legislation to codify that, the Protecting American Taxpayers from Wasteful Spending Act. One of the provisions of this EO is directed at your department, the Department of Treasury, to establish pre-certification and pre-award procedures across the federal government to prevent fraud and improper payments. So can you define for the committee today what an improper payment is and some examples of what you're seeing and why these procedures were not already in place before, Mr. Secretary?
Well, it's a bit mystifying why they weren't in place. And what we are seeing is that there was a very complacent upper level of management in many departments across the entire government. What I can say at Treasury, that of the 1.5 billion payments we send out every year, they're required to have something called a TAS, a Treasury account symbol. We discovered that more than one third of those payments did not have a TAS number. So as the Appropriations Committee, you should be shocked by that, because how can a payment be tracked back to an appropriation? Only through the TAS number. So there was no accountability. So that is why the 450 organizations that sit above Treasury, where Treasury acts as the paymaster, are unable to pass an audit. So we have cracked down on that. Every payment now requires a TAS number. Very simple, and I will tell you that the mid-level employees who I have had come into Treasury to talk to me about that feel liberated. That they have, they tell me, I've been here 20 years. I've always wanted to do this. I've been here 14 years, and they feel as though they now have agency and are making a difference towards saving the American taxpayer money.
So this is not only a complacency issue that you've fixed, but it's a morale issue for these employees who are helping to make the department much more efficient for taxpayers.
They're very energized by their participation.
Yeah, it's certainly unbelievable when you think about that this was not in place, and certainly it's we've got lots of examples from the previous administration of some of those catastrophic failures. Who would you say is benefiting from those improper payments, and how could a government agency really justify standing idly by while those errors were seeping into our system and making our government less efficient?
I can't speak to who was benefiting, but I can just speak to the attitude that has been shaken up, that this is okay, this is not okay, and this is taxpayer money, and we are charged with protecting it.
What other plans are in place to help implement that executive order? You've talked about the Treasury account symbol. Are there other things in that executive order that you are executing on today?
Well, again, the president, as you mentioned, has passed. We are trying to go more paperless with the checks, with the very important checks that the citizens across the U.S. receive, whether it's Social Security, veterans benefits, tax refunds. There is a substantial number of those are stolen. So the president has issued an executive order to try to make that more electronic. That will protect the integrity of those payments, as well as cut down on cost.
Have you been able to claw back any improper payments for the taxpayer, reclaim those dollars?
Yes, we've called back tens of millions of dollars.
Tens of millions. Well, look forward to continuing to work with you to improve those efficiencies and execute on that executive order. Appreciate the work you're doing at Treasury, Mr. Secretary. Thank you.
Thank you.
I yield back.
Thank you, Ms. Hinson. Chair now recognizes the gentle lady from Washington, Mrs. Glusenkamp Perez.
Thank you, Chair. And thank you, Secretary Bessent, for being here. So I ran an auto repair shop before coming here, and I know that people who are turning wrenches, who are filing an earned income tax credit or tax return, they're about 4 times more likely to be audited. And I'm wondering if you could talk to me about what the plan is for ensuring that regardless of what income strata you're in, your probability of being audited is equitable.
Well, Congresswoman, I think that was one of the problems with increasing the enforcement. There was nothing to say that there would have been more enforcement at any distributional level. So that what you were saying is that those receiving the earned income tax credit are more likely to be audited. That would have just meant more auditing. There was also a proposal to track small payments, $600 on Venmo, and things like that, which has been pushed back also.
But what is the forward program to ensure that there is an equitable? I mean, I have some quarrels with what you said, but what is the plan, the implementation plan to ensure moving forward we are getting towards a more equitable enforcement rate?
Look, we are reviewing the processes for who is audited at the IRS. There's been a great deal of politicization of that. So we are trying to stop that. And we are also going to look at the distribution of who is audited and why they are audited.
Look forward to hearing more about how that is being implemented and how we can help you with that. So I think you and I agree that the current trading system has failed working people who are turning wrenches, driving trucks, changing diapers. Could you expand on how the proposed tariffs would ensure that there is upward pressure on wages?
Well, I think that there are many parts to that, but the key to upward pressure on wages is more job opportunities. And what we have seen since what the so-called China shock after China entered the WTO was a large decrease in manufacturing jobs. And studies have shown that workers in manufacturing jobs have more potential for large-scale wage increases than service workers do. So moving more workers from service work to manufacturing, they should do that. And the administration is also trying to bring down the costs for working families.
I agree, right? If you are trying to earn a living as a barber, you have to move to a city to earn a high wage. But if you're in a rural community where there's a factory job, you can own land, you can own your home. And I think one of your points about financial literacy is ensuring that we do have economic self-determination. You can buy the pair of boots that will last 5 years and not be in this pace. But there's a lot of work to do here, building real wealth and not the nominal kind of, I'm not really here to be a defender of the stock market. Most of the people I know don't trade stocks in my community. It's a question of being able to own land, having that capital access to start your own business, and frankly, some of the antitrust work to ensure there's a level playing field for small businesses like mine. I'm hearing from constituents who have questions about their tax returns and are having trouble getting a real person on the line to speak to. What can we do? What is your plan for decreasing wait times, for having somebody be able to actually talk to a human being when they call the IRS?
Well, again, this goes back to my three priorities: collection, privacy, and customer service. So we are moving money into customer service at the IRS. And it's almost unimaginable that the phone banks had the same number of operators 24/7, 365 days a year. So if one of your constituents called on Christmas Eve, they'd probably get through because there were so many idle phones. If they called on April 14th, there was no surge to help them. So, as President Trump has repeatedly said, this is a common sense administration. So we're going to have common sense for the IRS. Playoff season is from January 15th to April 15th. Game days April 15th, and we're going to make sure that it's better staffed then.
Thank you. I yield back.
Thank you very much. Chair now recognizes the gentleman from Texas, Mr. Cloud, for his 5 minutes of questions.
Thank you, Chairman, and thank you, Mr. Secretary, for being here. I think it was Albert Einstein who said that you can't solve problems with the same kind of thinking you used when you created them. And that's one of the things I certainly appreciate about you and the Trump administration and what you're bringing to the table. For a long time, we've seen the managed decline of America, and while many who run for positions that we hold will campaign on the need to do something, what we've seen is too often, and even because some of the politicking we've seen today, for the sake of politics, we've not been able to do the big, hard things that we need to change course and get us out of the $36 trillion debt pathway and growing pathway that we're on, leading to that wall that you talked about. The American people have watched this all play out, realizing that their nation's been in decline and seeing what they thought was kind of the promise that if we put the experts in charge, they would run the government, we would have a regulatory pattern that worked, the wealth gap would close, America would be strong, and that has not happened. What did the experts get wrong that you're correcting?
Well, sir, under President Trump's first administration, the wealth gap did close. That the bottom 50% of households by net worth saw their net worth increase substantially more than the top 10%. And we are aiming to do that again. That under President Trump's first term, hourly workers' wage gains were higher than supervisory workers. And look, what people got wrong was the shock. And there was this terrible policy of, it was essentially compensate the losers. And I do not think that the American workers are losers. They were simply cast aside as the necessary collateral damage in this unfettered free trade. And the free trade is not always fair trade, and we can see that from the large surpluses that these countries are accumulating on the other side. So we are aiming for fair trade to bring back high-paying, precision manufacturing jobs to the U.S., and we are doing that. We're using tariffs, but we were also using the substantial deregulation, energy dominance, so we want to continue to make the U.S. an even more attractive location for manufacturing.
It's interesting you talk about manufacturing. I think it was in 2008, the intelligence community put out a report. I talk about it a lot because they said the greatest transition of wealth, power, and influence is happening right now. And this was some years ago. They said we expect it to continue, and it was going from the Western countries to the Eastern countries. And they said it was happening because we were sending manufacturing overseas and we were sending oil and gas revenues overseas. And yet they said it was like an unsolvable solution, yet we have the Trump administration who's coming in and solving what seems to be not an easy solution, but a very clear solution in bringing manufacturing back and bringing oil and gas back. And appreciate it. I wanted to ask you, because there was a comment about the bond markets, and certainly that's really is a concern. We need to make sure that they stay strong and that the dollar stays strong. Are the bond markets more affected by the tariffs and the concern we see in them now? Are they more affected by the tariffs or out of control debt and the fact that Congress can't seem to get our fiscal house in order?
Well, you know, I will tell you that the large stock of government debt is why I'm sitting here now, as opposed to back in the private sector. I became so alarmed by what was going on under the previous administration, this deficit that we had, highest ever, that when we weren't at war or weren't in a recession, and it's unsustainable. And I thought it was deeply cynical. And if we'd done it, if we'd continued it, then we would have gone into a malaise where we couldn't grow ourselves out. We would have probably been forced into looking more like a European-style economy, very high government spending, lack of innovation, and lack of mobility.
And that would matter for us here at home, but certainly even for the world, because we've kind of been the innovation engine of the world.
Yes, sir. But what we've created in the U.S. is this barbell economy, and the Trump administration is attempting to remedy that. On one side, we have financial services and the tech sector, which are forward-looking and the envy of the world. On the other side, we are a natural resources economy led by energy, which the previous administration, they stopped permitting for LNG facilities. But the arc in between is what we are missing, are these manufacturing jobs, and that's what we are trying to bring back.
Thank you, Mr. Secretary.
Thank you. The chair now recognizes the gentleman from Maryland, Mr. Ivey, for 5 minutes of question.
I appreciate you being here today, Mr. Secretary. I want to ask you a few questions about DOGE and the role it's playing at Treasury. You came into office, I guess you were sworn in on the 27th, was it? You were confirmed by the Senate on the 27th? Is that about right?
28th.
28th? Okay. And then you started working at Treasury immediately after that? All right, and DOGE began working there as well with respect to the payment systems?
Two individuals from DOGE who were actually Treasury employees were on site.
Okay. And I believe you were approached by the highest ranking career official at Treasury, David Lebrick. Am I pronouncing his name correctly?
I believe it's Lebrick.
Lebrick, okay. What was the nature of that conversation? I assume this was about the DOGE issue, but tell me briefly what that conversation was about.
Well, that conversation was about a discussion of the payment system. And when I go back to what I didn't know, I think I walked in the office around 3 p.m. and I think he and I were having a conversation at 4:30, and
I got to ask for the short version.
All right, Treasury Secretary Scott Bessent there testifying at a House Appropriations Committee hearing. Joining us now to talk more about what we expect from the president, from the secretary, I should say, and the president at this administration is Tyler Kendall. So are we getting any clarification here on trade policy, or is there really only one man, Tyler, that can answer those questions?
Yeah, hey, Matt. Well, we did hear some headlines here from the Treasury Secretary. As you note, the first question out of the gate was on tariffs, and he said that as of now, the U.S. has not engaged in negotiations with China, but did reiterate that we could expect to see some of those preliminary trade agreements as early as this week. Of course, we're not expecting those full deals, which can take months to end up implementing. But he did sort of set a timeline here, said that he expects 80 to 90% of our top 15 trading partners to clinch deals by the end of this year. Now, when he was asked about the potential economic impacts of his tariff policies, he did say that he does not think the U.S. is headed towards a recession. He said he is looking forward to the Q1 GDP numbers being revised. He ultimately called them noisy. As Bloomberg Economics says, the underlying pace of expansion will be tepid ahead as negative sentiment leads to lower consumer spending. We were hoping here to get a clearer picture on the X date, the day, of course, that the U.S. could default on its debt, because that is going to be absolutely important when we are talking about a hard deadline for lawmakers to pass their reconciliation package. He was asked directly about this, Matt. He said that that number is forthcoming, but that the Treasury ultimately is still working through its tax receipts from April.
All right, so a little bit there on the IRS. I guess a lot of people are still waiting to see money hit their account. In terms of the president, this administration, and the deals that are being done, what do we know about his meeting with Marc Carney?
Yeah, so Marc Carney is expected here at the White House shortly later on today. And this really is going to be a high-stakes meeting, considering that there has been very little, at least public progress, when it comes to trade talks with Canada. And Marc Carney sort of set the bar a little bit lower, if you will, ahead of today, saying that he understands that today's talks are going to be tough, but ultimately he hopes that they will be constructive. I don't need to tell you that the U.S. and Canada have one of the largest trading relationships in the world. Last year, they did about $916 billion worth of trade when it comes to goods and services. And Carney sort of outlined how he's going into this meeting today, saying that he wants to really hit on the full comprehensive picture and not just sector-specific trade talks, because keep in mind, Canada, of course, has been hit particularly hard when it comes to the tariffs, that 25% levy on all goods, excluding USMCA-compliant ones, the 10% levy on energy, but then also those sector-specific tariffs like steel and aluminum and autos have been a really big pain spot for Canada, considering how highly integrated these supply chains are, and that Canada's been a big exporter in these products to the U.S. I will add quickly, Matt, that the Commerce Secretary Howard Lutnick yesterday in an interview said that changes to USMCA-compliant goods likely aren't going to be discussed today. But when asked if he was optimistic about a trade deal with Canada, he said it's a complex situation and that today's meeting will be, quote, fascinating.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall there reporting live from the White House. You can continue to follow Treasury Secretary Scott Bessent's testimony on the Bloomberg terminal. Just type LIVE GO. Tomorrow, we're going to hear more from Scott Bessent when he goes before the House Financial Services Committee at 10 a.m., and we'll bring you that right here on Open Interest as well. In terms of the markets, we are only losing about half as much as we were previously in terms of in percentage terms. You can see the S&P 500 down 27 points, but still at 56.23. The 10-year yield barely budged at 4.35. Coming tomorrow, Meredith Whitney joins us. This is Bloomberg.